So, as some of you guys probably noticed, I did not make a video yesterday. Why is that? Well, because the markets were dismal, to say the least. And I didn't want to add insult to injury to an already bad situation, so I decided to save it for today. We need to talk about sell in May and go away, the common investment thesis that if you have not heard about, you are going to hear about because it starts next week. And it's literally how it says, sell in May and go away. Now, this May could be a little bit worse because of what we're going to go over here in this video. Things might get a lot worse before they get a lot better. And I'm not saying this to be the doomsday prepper, the guy that prepares you for the end of the financial markets. I'm not that guy. I'm bullish for the long term. But here in the short term, could be in for a little bit more pain. And I want to go over my thesis, why that is. And we're also going to talk about, obviously, SoFi Stock, because it is that time for a SoFi Stock update. Hit the like button, subscribe to the channel, do what you guys got to do in that regard. Thank you guys for those of you that went ahead and did that when I said so, even though you watch these videos, but you are not subscribed yet. So let's talk about it. Sell in May and go away. That's what I want to start off with. And really what is currently affecting the markets, because it's no surprise. The markets were down substantially. The S&P down 3.63%. NASDAQ closing down 4% negative. The first time so far in 2022 that has actually happened. Now, there's a lot of things that are actually happening under the surface. There's margin calls that are happening. Investors that used a lot of margin, a lot of institutional and hedge fund investors, not really the small guys. I think a lot of the small guys got rushed out of margin a long time ago. I mean, your average NASDAQ stock at this point is down over 60% from its highs. Some of the larger players like Apple, right, Amazon, Google, they're still not down that much. That's why the Russell and the NASDAQ are only down about 21% respectively. Maybe a little bit more for the Russell, but I know the NASDAQ is down 21%. Just this year alone. So like you hit a new 52-week low for the NASDAQ and the Russell on Friday. So margin calls are happening. That's an obvious fact. You don't see a 4% down day on the NASDAQ without some degree of margin calls and forced liquidations. Now, on top of that, what I personally think is going on is you just got a bad GDP report. Now, as I've said many times, the markets can trade off of fear. They can trade off of good news, bad news. They can trade off of catalyst in the short term. But what really supports the stock market is overall fundamentals. The stock market can only go up so long or down so long before fundamentals matter. So you really have that level where it's like, if the stock market's down here, to really put this simply, the stock market, let's say it's down here, but fundamentals are up here. Eventually, the stock market will more so match up with the fundamentals. Or if it's way overstretched, it will come down to that fundamental level over time. That's why the stock market historically has continued to perform well, because earnings have continued to perform well, right? Goes without saying. But what's happening right now is it comes down to the Fed and where the economy is. Like I just said, we had a really bad GDP print. I mean, GDP was down 1.4%. Like, if we have another negative GDP report in the next 3 months, you're in a recession. Welcome to the 2022 recession. Now, I don't know if if it'll be 2022 or if it'll be the beginning of 2023, but it is coming. The Fed knows it's coming. Investors know it's coming. Even regular people know it's coming to some degree if they watch the news or they just know anything about finance or the economy, right? So you have that going on. But what is going on with the Fed? Well, let's take a look at the federal funds rate. Federal funds rate is right here. It's at 0.25%. Now, you'll notice that anytime you head into a recession, the federal funds rate is high, and then the Fed can actually cut rates. That's what the Fed does to stimulate the economy during times of an economic slowdown, during times of a recession. They cut rates. And you see that every single time. The Fed will go in and cut rates. They will also increase their balance sheet as of 2008, when that became a major tool to fight an economic slowdown, to really support the dollar, support equity markets. So where are we currently at? Well, we're at 0.25%. Even though GDP was just terrible, stocks like Apple and Amazon, Apple reported decent earnings, right? They were good. They did forecast for a big hit next quarter, which some people are saying, that's probably a demand problem. It's not really a supply problem. It's more so a demand problem. And some people are chalking it up to that. But Amazon, terrible earnings. The only companies that really did phenomenal were Tesla and Microsoft. And these are companies, obviously, I'm saying, that control the broad indexes, right? So those stocks did well. The other ones, not so hot. So you don't really have the fundamental case supporting these current valuations, especially if this was the best earnings season you're going to see. I don't know what the next quarters will have in store, but I doubt it's going to be better than 2021, when you had a bunch of funny money out there, people going crazy, spending money on everything. I mean, everybody was going to a Louis Vuitton store, a Gucci store. People were going crazy, right? So I don't expect that kind of spending here in 2022. I've personally seen people cutting back. So you have that, not so great earnings. You have the fear of a recession and an actual GDP print, which reflects that fear. And then you have the Fed, like I said, at 0.25%. And you have the balance sheet at $9 trillion. Well, the Fed cannot ultimately add to their balance sheet all the time. They have to bring it down. On paper, if you were looking at the Federal Reserve as a stock, as a business, it would be a penny stock. You would never buy it. It would be insolvent. So they have to get that down. But the federal funds rate is the interesting part. Let's say the next quarter is really bad and we're going into recession, or the quarter after that. Let's say the November, September quarter, third quarter is really, really bad and we go into a recession. Well, the Fed, what they do is they cut rates, right, to support the economy. Well, if the rates are at 0.25%, they cannot support the economy. So in a weird way, the greater likelihood of actually seeing a recession sooner is going to make the Fed act more aggressively. Now, Wall Street in general, some analysts have said the opposite, have said that maybe, declining GDP coming in will really reduce the Fed's ambitions to raise rates. Well, I'm not in that camp. I think either way it goes, no matter what happens with unemployment, no matter what happens with inflation, GDP, they will have to raise rates at least to 2 to 3% before a recession comes. Could be next quarter, could be a year from now. We don't simply know. The Fed probably knows that. So what I'm boiling this down to, and why we really seen a massive sell-off, earnings are not supporting the markets. The Fed either way is going to have to get possibly more aggressive than they have even forecasted. And right now the markets are pricing in 3 back-to-back 0.5% rate hikes. That's what everybody's talking about. And a over 50% chance of a 75 basis rate hike coming at the next meeting. Not this meeting that comes this upcoming Wednesday, but the meeting after that one, which is going to be June 15th. In my personal opinion, that's going to happen. 0.5% at this meeting, 75 basis points at this meeting, or even 1% to even get ready for a possible recession. And I think that's what the markets are starting to realize. Now, why have the markets not really sold off in a substantial way? Why has there been safety stocks? Apple has held up very well through all of this. Well, it comes down to the fact of investors don't really take the Fed seriously. The Fed moves the markets, we all know that. But when the Fed comes out with super ambitious targets for the federal funds rate, getting the federal funds rate up to 2 to 3% by the end of the year, the markets expect the Fed to U-turn if the economy gets bad. And we just seen that bad GDP report, and it's not expected, widely that the Fed will U-turn. So I think the markets are starting to realize that, hey, the Fed has no choice here but to raise rates so they can cut rates once an economic slowdown does come or once a recession does come. Now, on top of that, you have sell in May and go away. Just great. This is this is what we needed. On top of everything else, you needed to sell in May and go away, right? It says seasonal trends could be a drag on stock market on a stock market that needs a rebound. Key points: rising interest rates, some high-profile earnings misses, and burgeoning concerns about global growth took a toll on the stock market in April. The big drawdown comes on an eve of an historically weak period for stocks, with the sell in May and go away mindset officially beginning this week. Next week. Some metrics and market action suggest that the sell-off in tech has gone far enough. Now, I don't know. It's one of those things where fear can take over here in the short term. That's why I'm not so bullish in the short term. But it says right here, quote, sometimes it is paid to lock in gains ahead of a traditionally challenging May through October periods. And this particularly goes for midterm election years, also known as sophomore slumps. Indeed, since 1992, the S&P 500 fell on average 3.4% in May through October period for midterm election years, Stovall said in a note to clients Monday. So that's that, especially in these midterm years. May does not tend to be a great time of the year. And this actually originated from an old English saying, sell in May and go away, come back on St. Ledger's Day. This phrase refers to a custom of aristocrats, merchants, and bankers who would leave the city of London and escape the country during the hot summer months. So pretty interesting. And if you guys have not heard about that, you're definitely going to hear, probably, you've heard about it from me if you haven't heard about it already, but you're going to hear about it a lot, especially if May is bad. Now, like I said, we do have that Fed meeting, and that is on Wednesday. That's really where you're going to get this whole sentiment of, the stock market's going to crash, or it's going to recover. It's going to be a buy the dip moment, like we seen with the last Fed meeting. March 14th, stock market started to rally, an historical rally to the upside, and then we've slowly been selling off. It's got a little bit more aggressive this week. We will say that, a 1.5% down day, and then a 2.74% down day, another 2.9% down day, and then the 3.7% down day. So it has got more aggressive. But is this going to be a buy the dip opportunity, a reversal like we seen last Fed meeting? See, I don't tend to really think so, because earnings kind of failed. Like during this time, we had good earnings Q1. Like all companies pretty much had good earnings. So you kind of had that stability. Now earnings are really up in the air. Companies, they're either meeting expectations or coming in under expectations, but they're also guiding lower. They're just guiding lower. Like Amazon guiding for 3 to 5% revenue growth. Apple projecting a massive hit from China. They're blaming it on supply constraints. A lot of people are saying, growth is slowing down, but you really don't have that earnings backfall to really fall back on. So I'm not convinced that we will see a rally after, the Fed meeting on Wednesday. If we do, great. If we don't, great. Why do I say that? Well, if we fall, then you're going to hit that bottom. The stock market can do well when the Fed raises rates, but not really when the Fed raises rates and the economy slows down and earnings really take a hit. So I think next Wednesday, you're really going to get that sentiment change, either buy the dip or the crash has started, essentially, right? That's going to be huge for the market. So I think that's really what we need to look forward to. And really, like I said, what has been happening this week is just massive margin calls. Like people are getting out of stocks. Like they're being forced to get out of stocks. Unless you had just bought the NASDAQ 100, over the past year, you're still down 21%. Like since 2022, you're still down 21%. So that's a substantial amount. But if you had bought individual stocks and you were a stock picker, then you're probably down closer to the average of what the NASDAQ 100 stock is down of, say, 50 to 60%. It has not been pretty. So you've seen a lot of forced liquidations, a lot of mass selling on Friday. So that's that. Let me know your thoughts down below in the comment section. What do you guys think about all of that information? I will say as well, there is a lot of margin debt outstanding. As of March, you still had about $800 billion of margin debt out there. Comparatively to the crash of 2020, March 2020, exactly 2 years ago, from this last March to 2020, margin debt was at about $479 billion. So there's a lot of margin debt that is still out there that can be squeezed out of the markets, and likely is starting to be squeezed out of the markets. Now let's switch gears and let's talk about SoFi stock. SoFi stock did not actually hit a new all-time low today. We closed at $6.12 per share, up 1 cent after hours. So we are currently at $6.13 per share. The all-time low is at $6.02 per share. So it's a very good thing that we did not hit a new all-time low today. And some stocks were down even more than SoFi was, down about 5.12%. And it comes down to, these stocks that got hit first, that are down 50, 60, 70, 80% from their highs, won't likely get hit as bad once the market comes down. Because I've said this before, if you guys have not subscribed to the channel, you don't watch all these videos, you might be a little bit confused. But when you see these turbulent markets, when you see a lot of instability in the markets, the first stocks that get hit are high growth stocks that trade off of price to sales ratios, not price to earnings or price to profit basis. Those stocks get hit first, and that's what has already happened. Those stocks are decimated, like just destroyed. There's no other way to put it. Like SoFi, destroyed. DraftKings, destroyed. Affirm, destroyed. They're all just done. Like those stocks are into the ground. Now, the stocks that are not are really your large tech stocks. Well, you just seen Amazon take a big hit. You've seen Tesla take a big hit. Microsoft came down quite substantially on Friday. Apple is still holding up quite well. It only went down about 2.5% on Friday. So those stocks are going to be the ones that really do come down 20, 30, 40%. Then you hit a bottom. Then you can reverse. And the reversal tends to come to the stocks that were already beaten down the most, and it's more aggressive to those stocks, right? Like you've seen the crash of 2020, recovery stocks, they were some of the first to get hit. They got hit the worst, but then they also rebounded in the most substantial way. I remember during the crash of 2020, I loaded up on a lot of recovery stocks. Within like 3 weeks, I was up 100% on pretty much everything, right? So that's kind of what I think will play out this time. You need to see a flush out of a lot of the safety trades, a lot of margin debt really come down. But then ultimately, I think you will see a big bounce back in stocks like SoFi, a lot of stocks that are beaten into the ground, especially if earnings do come out good for stocks like SoFi or for other stocks as well that are also beaten down a lot. Nonetheless, for SoFi, on the technical basis, watch the $5 level for support if we do head down, if the markets do break down even more. For the upside resistance level, watch $8.90 per share. If we do see a big bounce after the Fed, it would not surprise me to hit the the 1890 50-day moving average or the 100-day moving average at $11.35 per share. It's very, very possible. Now, if you guys are curious, I am down like 55% on SoFi stock. So you're not alone there. I have like $8,000 in it, and it's down like 4,500, almost 5,000. So virtually got evaporated at this point. So I am right there with you guys. Now, as far as SoFi and what is actually going on a day-to-day basis, well, there's a lot of shorts that are in SoFi. You could see the short interest is sitting at 20.07%. Current shares that are sold short that will eventually need to be bought back is sitting at 145.01 million. Cost to borrow max of 3.7%, utilization of 100%, and days to cover sitting at 3.87. So this situation, is not looking so hot, right? 20% short interest. That is driving the stock. That's driving the moves that you see in the stock. But what do you also see? You see a lot of longer term option activity, like a lot of the January 2023s, the January 2024 options that are coming through. Look at this $10 call for January 2024 coming in worth $500,000, $534.8 $1,000. People are bullish on SoFi in the long term. They're bearish on SoFi in the short term. Why? Well, because of what we are currently seeing in the marketplace. it's very obvious. Like these stocks that are down 60, 70, 80%, there's no real reason to be bullish in the short term. It comes down to the fundamentals of the business. If the business continue to get better over the next, we'll call it 2 years, then those options are going to pay out really big. And that's the main thing that I do want to stress as well right now is, the short-term pain, I feel you. I am down like 20 grand in stocks, which is like 40% of my portfolio. So it's not, or one of my portfolios, I should say. It's not a pretty picture. It's not. But it's not a loss technically until you realize that loss, right? So if you continue to add to your position, increase your ownership in SoFi or really any strong business for the long term, I believe you will do well. Obviously, don't take my advice. I'm not a financial advisor. I don't give out advice. I give my thoughts on the markets and what I specifically am doing and go over data. That is it. I'm not your financial advisor, but that's my personal philosophy on the whole thing. Now, as far as the option activity, for Friday, you've seen 95% positive order value. 5 orders totaling $3.13 million. Over the past week, 61 orders totaling $14.02 million. Positive order value of 85%. So really in this next upcoming week, we'll go over all the economic data that you guys need to know in the video, coming out tomorrow. That's going to be very important. Obviously, there is economic data as well as the Fed. But really, the Fed is either going to cement a crash and ultimately hitting a bottom, or it's going to, buy the markets more time before we inevitably do flush out and do crash all the way down. So really, those are my thoughts. Next week is going to be a very important week for the broad markets, and those are my thoughts on SoFi. So hit the like button, subscribe to the channel, do what you guys got to do. Thank you guys for tuning in. You guys enjoy the rest of your weekend, and I will see you in the next one.